Welcome to Morningstar. My name is Christopher Johnson, and today I'm joined in the studio by Stephen Yu, the Managing Partner and CIO of the Blue Whale Growth Fund. Stephen, thank you so much for being here with me. So my first question to you is about Nvidia. So it is the top holding of the fund. And an investor of Lion Trust was recently interviewed on CNBC, and she argued that despite Nvidia's high valuation, it is currently undervalued. Do you agree with this statement?
Yes, we do agree that depends on which time period you're looking at Nvidia. So on a 1-year PE ratio basis, if you follow them using the market consensus, it's actually trading at a similar valuation to Microsoft and Amazon. So of course, then if you believe that Amazon or Microsoft are overvalued at over 30 times earnings, and so are Nvidia. But if you believe that 30 times earnings for those businesses are okay, then Nvidia is not overvalued. But of course, over the medium term, in the next 3 to 5 years, that we do believe that Nvidia is going to make a lot more money in terms of selling more of the GPU in revenue terms, and just because the business in itself is very high margin in terms of operation, so they're going to deliver a lot of free cash flow back to shareholders. And to our mind, I mean, we have been invested in Nvidia since 2021, and then we have increased our position quite a lot in 2022 when the share price came back down a lot. And we still maintain a very large position, just short of 10%. So to our mind is we have no doubt that Nvidia is going to become the biggest company in the world in time, surpassing both Apple and Microsoft, which is not a long way to go. But of course, from an investment manager perspective, that if Nvidia is going to do that within the next 12 months or so, I think we are very happy with that. But if Nvidia is going to take another 3 years to do that, we'll be happy too. But then we might have a smaller position. So it's one of those things that we want to optimize the performance of the fund in time. But as far as the prospect of Nvidia is concerned, like, we have no issue with that.
At the Morningstar Investment Conference in London, there was a panel discussion about AI, and people were talking about the ramifications due to it maybe using kind of the intellectual property from other content out there. Do you think this is a risk that maybe investors are not seeing with AI?
This is the direction of travel, so there's going to be more regulations coming in, and the regulators are coming to challenge some of this. I think the one company that's slightly questionable today is OpenAI, because they do not disclose their source, how they come to do the training. But if you look at, for example, Adobe Firefly, which is a competing product to Midjourney. Midjourney doesn't disclose their source as well. If you were a creative professional to use Adobe Firefly rather than Midjourney to generate an image using like the GPT capability, they guarantee you that is copyrighted in a way that there's no issue. They would be paying whoever have generated the images or the video that have fed onto the AI to do the learning and then gave you the output. So what Adobe is doing is to assure the enterprise customers that you're not going to just generate some images and then you suddenly get a lawsuit. So hence for the very large enterprise customer, they would be still using Adobe Firefly rather than Midjourney for maybe just an Instagrammer. And then on the other hand, if you look at maybe the music industry, I think last year there was some music that's being generated by AI using like an existing artist archive, and it was very popular. But of course, and what has happened is the record companies, the labels, have then said to the likes of Spotify or Amazon Music that you need to take this down because it's copyrighted, and which they did. So I think the direction of travel is like you would continue to see it as a two-way of coming up with like the output on the back of generative AI. But I think for the more sophisticated market, like the enterprises, like if you're a big company, you would rather not take the risk. So you need to basically do what you need to do to satisfy the current regulations.
At the end of December 2023, according to Morningstar data, you sold 780,000 shares in Universal Music Group, reducing your position. What led to this decision? And did it have anything to do with the months-long licensing fee between the group and TikTok?
So not so much about TikTok. So basically, we invested into UMG about 2 years ago, and we actually recently exited our position completely. So we sold out from the shares completely. Only on the back of two things. One was on valuation ground, that it's done very well for us. I think the thesis that we held at the time that the group was undervalued for how well they monetize the music, partnering with Spotify, Amazon, Instagram, and some others. Of course, TikTok was also one of the players. But So that is play out quite well. We have no concern about that part of the market. We had not so much concern about AI music being generated using the existing kind of artist or the kind of the label archive, because they have very strong relationship with the distributor, which are the Spotify, the Amazon Music, so they can force them not to embrace that. Okay, what is slightly questionable in terms of the AI threat to the music industry, we don't know that, whether it's going to materialize or not. It's a speculation based on our take today, is how we come to know about a pop star like Taylor Swift or some others, is the record label have spent a lot of money to build up that sort of a character or the artist in itself. And of course, then they do a lot of concerts. It's exceptional artists and all that stuff. And because in terms of how we receive the kind of the music and all that, it's also quite controlled in a way that, okay, if that got recommended to you, if they have more money to spend doing tours, then you come to learn about them. If they have money to spend on Instagram, then you come to know about them, etc. But in time, what we don't know is whether AI is going to change that in terms of how we receive music, not in terms of the generation of music. Is whether then suddenly maybe the big star, the big pop star or artists are no longer for everyone. That maybe it's the smaller artist that doesn't even have a record label to back them up, that because of the recommendation system that they get to know a lot more about you, let's say Spotify, know about what you like, and then they start recommending you stuff that are not the kind of the artists being backed by the record labels. So then whether that would change the pattern in terms of the business model of the record label, because at the moment, of course, they have all the archive, which they're making a lot of money from. But then we're talking about what's going to happen in the next 20 years. Are they going to have the next Taylor Swift? Or is this Taylor Swift going to be coming from somewhere else that's not backed by a record label? So that is just a question mark that we are debating, but because of valuation ground, is deliver what we expect them to do, and then we've made quite a lot of money over on the back of that, so we exited the position.
According to Morningstar data, your fund returned 29.5% over the 3 years to May 2024 versus the Morningstar Global Growth Index, which returned 13.36%. So what do you think has been the key to the fund's outperformance apart from Nvidia?
In Q4 2022, we initiated our first and only energy company called Canadian Natural Resources, which is currently in the top 10. And that company actually has gone up quite a lot, about 50% return between Q4 2022 until now. So it's done very well. That is on the back of our view that oil price is going to be well supported at a high level than before, just on the back of the geopolitical uncertainties in the Middle East in particular. And then at the same time, if you look at like MasterCard and Visa, you would think, okay, these two companies sounds quite boring. Everyone knows about this company, but we actually would categorize these two companies as the new regime beneficiaries. So they're going to benefit more on a high level of inflation. How are they going to do that? It's just on the back of them charging us a fee on our nominal spending. So not on our discretionary spending. So if you go to supermarkets, the inflation at 5% or 10% before, you just end up paying more using your debit card or credit card. And then if you think about going back to the pre-pandemic period, the inflation number for consumer spending is 1 to 2%. Going forward, it's likely to be 3 to 4%. So they just have a natural tailwind of making more money on top of the digital transformation from cash to contactless to digital. And of course, these companies are very high margin businesses, right? So any way of making more money on the top line would then get translated onto the bottom line because they are operationally geared, being very tech savvy. And at the same time, one area that we haven't talked about, which is very exciting for us, which is semiconductors equipment companies. So we currently, within our top 10, we have Applied Materials and Lam Research. And last year, we had ASML, which we exited on valuation ground. But in terms of the end market dynamics, will be quite similar. So why is it so exciting about this company? And we actually categorize the semiconductor equipment company under the new regime beneficiaries. So not within the AI, because they don't actually do a lot in AI. It's on the back of the geopolitical uncertainties that with the CHIPS Act in the US, with a similar kind of mandate in EU, there are over $100 billion worth of tax subsidy today to incentivize companies like TSMC, Samsung, and Intel to build new foundries in the Western world, because currently Taiwan control over 90% of the high-end semiconductor equipment. semiconductors production. And if tomorrow, let's say Taiwan is no longer autonomous, let's say somehow it become part of China, and then China ended up weaponizing semiconductors, I mean, we will be in trouble, right? So the Western government has recognized that 2 years ago, back in 2022, that we need to have more foundries being built so that we can produce the chips that we need ourselves. And then if you look at the numbers today, there's over 300 to 400 billion dollar worth of commitment to build new foundries in the US, in Ireland, in Germany, in France, in South Korea, in Japan. So then if you're selling the mission critical equipments into this foundry like Lam Research, Applied Materials, or even ASML, then you end up selling a lot more of your equipments into these foundries. So this is what is very exciting, that like you would think typically the sector in itself is quite cyclical because the end market are consumer-facing PCs, smartphone, or autos. But because of the tailwind they're experiencing on the back of the government backing this dramatically, because we think this is the most important reshoring in terms of silicon sovereignty, like we need to be sovereign in terms of the silicon, access to silicons, then the government is putting the full force behind the scene. And of course, when you talk about building a foundries, I mean, you're talking about billions of dollars, and it would take at least 3 to 5 years in order for a foundry to be completed. So then we're actually very excited about this area that we think is going to benefit on the back of this new regime.
Stephen, thank you so much for taking the time to speak to me.
Thank you.
This is Christopher Johnson from Morningstar UK.